If you are an investor, pay close attention to the taxes you will have to pay on your investments. Many times, you can legally cut, delay, or even eliminate taxes on your investment gains, allowing you to keep more of your profits. So knowing the best strategies to reduce your taxes and keep more of your money working for you is essential. Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 tax-efficient investing strategies. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Number 10. Diversify taxably. Diversifying your investments across asset classes can help spread risk and increase returns. It is therefore critical to diversify your tax exposure. You can better control your tax obligation while enjoying the benefits of diversification by keeping a mix of tax-efficient and tax-inefficient investments in your taxable accounts. Number 9. Practice buy and hold investing. The IRS tax laws have a crucial caveat. You are only taxed on realized capital gains or when you sell an investment for cash. That is a massive legal loophole for you to exploit. As long as you don't sell, you won't have to pay capital gains taxes, which can be significant. In fact, you can hold your investments indefinitely and delay paying capital gains tax forever. However, this is only one aspect of the advantages of the buy and hold strategy. If you buy and hold, your investments will most likely perform better. Over lengthy periods of time, research repeatedly shows that passive investing outperforms active investing. So buy and hold investing can benefit you in two ways. You'll likely make more money and pay less to the IRS. Number 8. Open an IRA. An IRA is a terrific tool for employees to save for retirement while still receiving tax benefits. A typical IRA allows you to save money before taxes, lowering your taxes this year. You'll be able to postpone paying taxes on your winnings, whether they're capital gains or dividends. When it comes time to withdraw distributions from the account beyond the age of 59, you must pay taxes on any money taken out. As a result, you can legally delay taxes in an IRA for decades. A Roth IRA, on the other hand, can keep the IRS out of your pocket for good. The Roth IRA allows you to save money after taxes, which means you won't get a tax break this year. However, you can increase your contribution tax-free and then withdraw it tax-free after you reach the age of 59. It is largely regarded as the expert's best choice among retirement funds. Number 7. Contribute to a 401(k) plan. An employer-sponsored 401(k) plan provides many of the same tax benefits as an IRA, as well as a few extra. A standard 401(k) allows you to defer money from your paycheck pre-tax, lowering your taxes this year. You will be able to postpone paying taxes on any earnings, whether capital gains or dividends. You must pay taxes on any withdrawals from the account after the age of 12. You can effectively defer investing returns for decades while working. A Roth 401(k) provides many of the same benefits as a standard 401(k), such as paycheck deferral, employer match, and more, but it does so after tax, which means you'll still have to pay taxes on any contributions. You can, however, develop your account tax-free and then withdraw any money tax-free when the time comes to collect dividends. You can even subsequently convert it to a Roth IRA. Number 6. Take advantage of tax loss harvesting. Tax loss harvesting can help you decrease or eliminate taxable capital gains. The IRS permits you to write off realized investment losses against your gains with tax loss harvesting, so you only owe tax on your net capital gain. For example, if you made a $10,000 profit on one investment but lost $8,000 on another, you can offset the losses. You'll end up with a $2,000 taxable gain and a significantly lower tax payment. You can even offset more than you've gained, up to a net $3,000 loss in any tax year. If your net losses exceed that amount, you must carry them forward to future years. For example, if you make a $10,000 profit on one investment and a $15,000 loss on another, your net loss will be $5,000. However, you can only claim a $3,000 loss on your tax return this year, while the remaining $2,000 loss can be claimed in future tax years. Number 5. Consider asset location. In general, you are required to pay taxes on dividends and any other cash distributions in the same year that you receive them. If you are making use of a taxable account, then you do not have a wonderful means to squirm out of taxes in this situation, as you can with capital gains. Think about where you maintain your assets if you want to pay the least amount of tax possible on your dividends. You might, for instance, have a brokerage account that is subject to regular taxation in addition to a tax-deferred account, such as an individual retirement account, IRA. If you have dividend stocks, it can make sense to keep those stocks, or at least the majority of them, within the tax-light boundaries of your individual retirement account, IRA, so that you can avoid paying taxes on the distributions that are made today. On the other hand, stocks that are expected to experience capital gains can be kept in a standard taxable account. Number 4. Use a 1031 exchange. If you are an investor in real estate and you are wanting to reinvest the proceeds from the sale of a property that is not your primary residence, it may make a lot of sense for you to do something called a 1031 exchange. You can sell one investment property and defer your capital gains with the help of the 1031 exchange, which is a type of like-kind exchange, provided that you invest the profits from the sale within a reasonable amount of time in another investment property. The regulations that govern a 1031 exchange can be difficult to understand, but they must be followed to the letter in order to maintain your tax deferral. You can hold on to your investment and delay the realization of capital gains, just like you can do with other kinds of assets, perhaps for decades. Number 3. Take advantage of lower long-term capital gains rates. The taxation of income from investments is distinct from the taxation of income from wages. This distinction may be notably apparent in the manner in which capital gains are handled. The Internal Revenue Service has 3 different tax brackets for long-term capital gains: 15%, 20%, and 0%. Absolutely 0%. However, you must adhere to the guidelines with extreme precision. These tax rates are often lower than what you'll pay on short-term capital gains, which are taxable at the same rate as regular income. Number 2. Leverage tax-advantaged accounts. Taking full advantage of tax-advantaged accounts is one of the most effective strategies to reduce the amount of tax that you are required to pay on your investments. These types of accounts, such as individual retirement accounts, IRAs, 401(k)s, and health savings accounts, HSAs, provide tax advantages that over the long term can dramatically increase your returns on investment. Think about contributing the maximum allowed to these accounts so that you can take advantage of the growth that is tax-free or tax-deferred. Number 1. Seek professional advice. Tax laws and regulations are notoriously difficult to understand and are frequently updated. It may be extremely beneficial to consult with a financial advisor or tax specialist who specializes in tax-efficient investing before making any investment decisions. They can guide you through the maze of the tax code, help you spot possibilities, and assist you in making informed decisions that are in line with your financial objectives. It is crucial to include tax-efficient investment techniques in your financial plan if you want to maximize your returns and accomplish your long-term financial goals. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.